Most people think debt is just a tool. Something neutral, something normal, something everyone uses so it can't be that bad. That belief ruins more lives than bad investments ever will. Warren Buffett didn't think about debt the way most people do. Not even close. And the surprising part isn't that he avoided it. The surprising part is why. Because for Buffett, debt wasn't mainly a money problem. It was a thinking problem. Most people believe debt helps them move faster. Buy sooner, grow sooner, live sooner. But Buffett saw something most people never notice. The moment you owe money, your thinking quietly changes. You don't feel it right away. There's no alarm, no warning sign. But something shifts. Decisions get shorter. Patience shrinks. Fear sneaks in. And once fear is part of your thinking, your options start disappearing. Here's what most people don't want to hear. People rarely go broke because they made one terrible investment. They go broke because debt slowly pushes them into decisions they would never make if they were free. Free to wait, free to say no, free to think clearly. Buffett understood that debt doesn't just cost interest, it charges you mentally, every single day. Even when things are going fine. When you owe money, you stop asking, is this a good decision? And start asking, will this work in time? That question alone changes everything. Most people think success comes from being bold. From taking risks, from using leverage, from putting money to work. But Buffett noticed a pattern early in his life. The people who survived the longest weren't the smartest or the fastest. They were the ones who didn't owe anyone anything. Because debt doesn't just limit your money, it limits your behavior. When you owe, you can't afford patience. When you owe, you can't afford mistakes. When you owe, you can't afford long-term thinking. You might still talk about long-term plans, but your actions tell a different story. You start chasing short wins. You start forcing outcomes. You start needing things to go right. And needing things to go right is one of the most dangerous positions you can be in. Buffett didn't hate debt because it was evil. He hated it because it removes your margin for error. And in the real world, error isn't optional. It's guaranteed. Markets move. Businesses fail. Income changes. Life happens. Debt assumes stability in a world that has none. That's the part people miss. They run the numbers, they calculate the interest, they compare rates, but they never measure the cost of stress, pressure, and forced decisions. And those costs don't show up on spreadsheets. They show up in panic selling. They show up in bad partnerships. They show up in rushing into things you don't understand. Buffett watched this for decades. He watched people with talent destroy themselves because debt made them impatient. He watched smart investors take dumb risks because they needed returns now. He watched businesses fail not because the idea was bad, but because timing mattered and debt removed flexibility. Most people think debt gives them options. Buffett knew it takes them away. Because the moment you owe, time stops being your friend. You stop waiting for the right deal and start grabbing the available one. You stop thinking about downside and start praying for upside. You stop protecting yourself and start gambling quietly. And that's the part nobody likes to admit. A lot of what people call investing while in debt is just gambling dressed up in nice words. Clean spreadsheets, optimistic projections, confident explanations. But underneath, it's fragile. Buffett never liked fragile systems. Not in business, not in investing, not in life. He believed real wealth isn't measured by how much you earn, but by how much control you have over your decisions. And debt, no matter how cheap or common, always reduces control. Even when things are going well. Especially then. Because debt feels safest right before it becomes a problem. That's why this topic matters so much. Not because debt is rare, but because it's normal. Accepted, encouraged, built into modern life. And when something becomes normal, people stop questioning it. Buffett never stopped questioning it. He asked a different question than everyone else. Not can I afford this, but what does this force me to do later? That question changes how you see everything. It changes how you see investing. It changes how you see risk. It changes how you see freedom. Most people chase returns. Buffett chased resilience. Most people want more money. Buffett wanted fewer obligations. Most people measure wealth by lifestyle. Buffett measured it by independence. And debt works directly against all three. It ties your future to fixed outcomes. It locks you into schedules you don't control. It turns flexibility into a luxury. You can still succeed with debt, Some people do. But Buffett understood something uncomfortable. Success with debt often comes from luck, while survival without debt comes from structure. And luck runs out. The reason Buffett's view on debt surprises people is because it's not extreme, it's not emotional, it's not moral, it's practical. He didn't say debt makes you bad. He believed it makes you vulnerable, and vulnerability compounds in the wrong direction. One small mistake becomes a big one. One delay becomes a crisis. One bad year becomes permanent damage. Without debt, mistakes are lessons. With debt, mistakes are threats. That's the difference. And once you see debt this way, you can't unsee it. You start noticing how many decisions people make, not because they're good, but because they're necessary. You start seeing how often people rush, not because they want to, but because they have to. You start seeing how debt quietly taxes thinking before it ever touches money. This video isn't about shaming debt or pretending it doesn't exist. It's about understanding why one of the most successful investors in history treated it with extreme caution, while the rest of the world treats it like a shortcut. And the reason matters more than the rule, because Buffett didn't avoid debt to look conservative. He avoided it to stay rational. And in a world where most people are forced to react, being able to think clearly is the real advantage. That's what we're going to break down. Not the slogans, not the surface advice, but the way debt quietly changes how you think, how you act, and what options you actually have. And once you understand that, you'll start seeing debt very differently than you did before. Before we go any deeper, it's important to clear something up. This video is not about saying debt is always bad. It's not about pretending the modern world doesn't run on credit. And it's definitely not about judging people who use debt to survive or get started. Warren Buffett didn't see the world in extremes. He didn't divide people into good and bad based on financial choices. What he cared about was how decisions affect behavior over time. And debt, in his eyes, was never just a math problem. It was a pressure problem. Most people talk about debt using numbers, interest rates, monthly payments, percentages. That's how it's usually taught. As something you can manage as long as the math works out. Buffett looked past the math and focused on something else. What does this obligation do to the person holding it? Because money decisions don't happen in a vacuum. They happen in real life, under stress, with uncertainty, with emotions, and with imperfect information. And debt changes how you behave in those moments. That's why Buffett's thinking surprises people. Not because he hated debt, but because he understood its second-order effects. The effects that don't show up right away. The effects that only become visible when things stop going according to plan. Most people only think about debt when they take it on. Buffett thought about it years later, when life inevitably throws something unexpected at you. A job loss, a bad year, a market drop, a health issue. He didn't ask, "Can this work if everything goes right?" He asked, "What happens if it doesn't?" That single question explains almost everything about his approach. Buffett grew up in a time when debt wasn't celebrated the way it is today. Borrowing was cautious, conservative, often uncomfortable. Over time, that cultural attitude shifted. Today, debt is marketed as empowerment, as leverage, as acceleration, as a smart move if you're disciplined. And for some people, in some situations, it can work. But Buffett noticed something most people miss. Even disciplined people stop being disciplined when pressure increases. That's not a flaw. It's human nature. The more fixed obligations you have, the fewer options you have. And the fewer options you have, the more likely you are to make short-term decisions just to get through the moment. Buffett wasn't trying to be pure. He was trying to stay flexible. That's a huge difference. Flexibility means you can wait. It means you can say no. It means you can walk away. Debt slowly removes those abilities, even when things are going well. That's why Buffett didn't think of debt as bad or good. He thought of it as fragilizing, something that makes your system more sensitive to stress. And he hated fragile systems. In business, in investing, and in personal finance, he always favored setups that could survive mistakes. Because mistakes are not rare events, they're normal. Most people plan their finances assuming stability. Stable income, stable health, stable markets, stable costs. Buffett assumed the opposite. He assumed volatility. That assumption alone puts you on a completely different path. When you assume stability, debt looks manageable. When you assume volatility, debt looks dangerous, and Buffett always assumed volatility. This is why he didn't like the idea of optimizing finances with debt. He wasn't trying to squeeze every drop of efficiency out of the system. He was trying to avoid collapse. That mindset is deeply misunderstood today. People often say Buffett could afford to avoid debt, but that misses the point. He avoided debt before he could afford not to. Because avoiding debt wasn't the result of his success, it was one of the reasons he survived long enough to succeed. This intro matters because it reframes the entire conversation. If you think Buffett avoided debt because he was rich, you'll dismiss his ideas as irrelevant. If you understand that he avoided debt to protect his thinking, his ideas suddenly apply to almost everyone. Most people don't realize how much debt shapes their mindset until they don't have it anymore. When you owe nothing, your thinking slows down. You don't rush. You don't panic. You don't force outcomes. You start making decisions based on quality instead of urgency. Buffett valued that state of mind more than almost anything else. He believed rational thinking is your biggest asset. And debt, even manageable debt, quietly interferes with rational thinking. Not dramatically, not all at once, but slowly. You start cutting corners. You start accepting deals you normally wouldn't. You start saying yes when you should say no. Not because you want to, because you have to. This is where most people misunderstand Buffett's position. They think he was afraid of risk. In reality, he was afraid of forced risk. There's a big difference between choosing risk and being pushed into it. Debt pushes. It pushes you to earn on a schedule you don't control. It pushes you to act before you're ready. It pushes you to stay in situations longer than you should. Buffett wanted none of that. He wanted optionality, the ability to choose, the ability to wait for good opportunities instead of chasing acceptable ones. That's why he didn't admire people who used debt to grow fast. He admired people who could stay patient without it. Patience is easy to talk about. It's very hard to practice when bills are fixed and time feels short. Buffett knew that if he could protect his patience, the rest would take care of itself. This video isn't going to tell you to eliminate all debt tomorrow. That would be unrealistic. What it will do is help you see debt through Buffett's lens, not as a number on paper, but as a force that shapes how you think and act. Once you see it that way, you stop asking, "Is this debt cheap?" and start asking, "What does this debt make me do?" That question is the foundation of everything that comes next. Because Buffett didn't win by predicting markets. He didn't win by being flashy. He didn't win by taking extreme risks. He won by protecting his ability to think clearly for a very long time. And debt, in his mind, was one of the biggest threats to that clarity. Now that you understand why Buffett cared so much about debt, we can talk about the real problem. How debt quietly traps people into bad decisions without them even noticing. The real problem with debt isn't that people don't understand it. Most people do. They know what interest is, they know what monthly payments are, they know what they owe and to whom. The problem is that people misunderstand what debt does over time. Debt doesn't usually break people in one dramatic moment. It doesn't show up as a sudden disaster. It works slowly, quietly, and patiently. And that's exactly why it's so dangerous. Buffett noticed this early on. He saw that debt rarely destroys people directly. Instead, it changes how they behave. And once behavior changes, outcomes follow. Most people think debt is a financial obligation. Buffett saw it as a behavioral constraint. When you owe money, you are no longer fully free to make the best decision. You are free to make the necessary decision. That difference matters more than people realize. At first, nothing feels different. You take on debt, and life continues. You still think clearly, you still plan, you still feel in control. That's why debt feels harmless early on. But slowly, something shifts. You stop asking what's best in the long term, and start asking what works right now. Not because you want to, but because obligations don't wait. Bills don't care about timing. Interest doesn't pause for reflection. Deadlines don't respect uncertainty. Debt introduces urgency into places where patience is supposed to live. Buffett understood that urgency is the enemy of good thinking. When urgency enters the picture, people start doing things they would never do if they weren't pressured. They take jobs they don't want. They accept partnerships they don't trust. They invest in things they don't understand. Not because they're reckless, because they're cornered. That's the problem most people miss. Debt corners you quietly. It doesn't shout, it whispers, it tells you, just make this work. And when you hear that often enough, you start bending your standards. You lower your requirements, you accept thinner margins, you take on more risk than you should. And every small compromise feels reasonable on its own. Buffett watched people do this repeatedly. Smart people, hardworking people, people with good intentions. Debt didn't make them stupid. It made them impatient. And impatience destroys judgment. Another part of the problem is that debt creates false confidence early on. When things are going well, debt feels like a smart move. Payments are easy, progress looks fast, leverage seems efficient. This early success tricks people into believing debt is under control. Buffett knew this phase was the most dangerous, because debt feels safest right before it becomes a problem. People don't worry when income is steady. They don't worry when markets are up. They don't worry when projections look good. But life doesn't stay in that phase. Income changes, markets move, unexpected costs appear, and debt doesn't adjust. It stays fixed. That's when pressure enters. Now, decisions aren't about growth, they're about survival. And survival thinking is very different from investment thinking. When you're in survival mode, you don't ask, is this a good long-term decision? You ask, will this keep me afloat? That mindset pushes people into bad trades, rushed investments, and fragile strategies. Buffett always wanted to stay out of survival mode. He believed that once you are forced to act, you are already at a disadvantage. The best decisions come from choice, not necessity. Debt removes choice. Another problem is that debt changes how people measure success. Instead of measuring success by quality, they measure it by speed. How fast they can grow, how fast they can earn, how fast they can recover. Speed becomes the goal because time feels expensive. Buffett didn't chase speed, he chased durability. He knew that fast growth built on pressure is unstable. It looks impressive until it breaks. Debt makes people chase returns not because returns are attractive, but because returns are required. That difference is subtle, but critical. When returns are required, risk tolerance changes. People start justifying behavior they would normally avoid. They invest in things they don't fully understand. They rely on forecasts instead of fundamentals. They assume best-case scenarios, not because they believe them, but because they need them. That's not investing, that's hoping. Buffett had no interest in hope-based strategies. He believed any plan that requires everything to go right is a bad plan, and debt-based plans often fall into that category. Another part of the problem is psychological. Debt adds mental noise. Even when people say debt doesn't stress them, it usually does. Quietly, it sits in the background. It shortens patience. It increases sensitivity to short-term results. People with debt check prices more often. They react faster to bad news. They feel pressure when nothing is actually wrong yet. This constant low-level stress interferes with clear thinking. Buffett valued clarity above almost everything else. He knew that a calm mind sees opportunities that a stressed mind misses. Debt robs people of that calm. Not dramatically, gradually. Another issue is that debt reduces the ability to say no. When you owe money, you can't easily walk away. From jobs, from deals, from situations that don't feel right. That loss of optionality is massive. Buffett structured his life and finances to preserve optionality. He wanted the freedom to wait, to walk away, to do nothing when nothing made sense. Debt removes that freedom. You can still succeed with debt, but success becomes conditional. It depends on things going right. Buffett hated conditional success. He preferred slow progress with high certainty over fast progress with fragility. Most people never frame the trade-off this way. They see debt as a bridge. Buffett saw it as a narrowing path. Another major problem is that debt hides failure until it's too late. When someone has no debt, mistakes are uncomfortable but manageable. When someone has debt, mistakes become threats. That changes behavior fast. People hold on to bad positions longer. They double down instead of stepping back. They avoid admitting mistakes because the cost feels too high. Debt turns small errors into emotional crises. Buffett believed the goal wasn't to avoid mistakes, it was to make sure mistakes were survivable. Debt reduces survivability. That's why he avoided it whenever possible. Another overlooked issue is how debt affects learning. When you're under pressure, you don't learn well. You react. Buffett was a lifelong learner because he gave himself space to learn, space to think, space to change his mind. Debt compresses that space. When every decision feels urgent, reflection disappears. People repeat mistakes because they never stop long enough to understand them. Buffett believed reflection was part of compounding, learning slowly, correcting early, improving over time. Debt disrupts that process. The final part of the problem is cultural. Modern culture treats debt as normal, even responsible. It's built into housing, education, business, and lifestyle. Questioning it feels unrealistic or outdated. Buffett didn't care about appearing modern. He cared about what worked over decades. He knew that normal doesn't mean safe. Many things that are normal are fragile. Debt just happens to be one of the most dangerous because it ties future decisions to past assumptions. If those assumptions fail, the cost shows up later when it's hardest to adjust. That's the real problem. Debt locks you into yesterday's optimism. Buffett wanted the freedom to adapt. He wanted to be able to change his mind without consequences, to wait without pressure, to think without noise. And debt, even good debt, made that harder. This is why Buffett's thinking surprises people. He didn't see debt as a shortcut. He saw it as a trade, and most people underestimate what they're trading away. They trade patience for speed. They trade flexibility for leverage. They trade clarity for optimism, and they don't realize the cost until later. That's the problem we're really talking about. Not numbers, not rates, not formulas, but how debt quietly reshapes behavior in ways that work against long-term success. Now that we understand the problem, the next step is to explore how Buffett structured his thinking and his life to avoid these traps, and what that approach looks like in practice. Once you understand the problem with debt, the next question is obvious. So what did Buffett actually do instead? The answer isn't flashy. There's no trick, no clever structure, no secret leverage strategy. What Buffett did was far simpler and much harder than most people expect. He built his entire financial life around not needing things to go right. That sounds abstract, but it shows up in very concrete ways. Buffett didn't try to eliminate uncertainty. He assumed it. And because he assumed uncertainty, he built buffers everywhere. Buffers of cash, buffers of time, buffers of patience. Debt works against buffers, so he minimized it. This wasn't about being conservative for the sake of it. It was about staying in control when conditions changed. Buffett knew that the biggest advantage you can have is not intelligence or speed. It's freedom of action. And freedom of action disappears the moment obligations dictate your next move. So instead of asking, "How can I grow faster?" Buffett asked, "How can I avoid being forced?" That single shift in thinking changes everything. When you don't owe anyone, your timeline becomes flexible. You don't need immediate results. You don't need perfect timing. You don't need forecasts to be right. You can wait. Waiting is a skill Buffett mastered early. He was comfortable doing nothing while others rushed. Not because he lacked ideas, but because most ideas weren't good enough. Debt makes waiting painful. No debt makes waiting powerful. Buffett understood that the best opportunities don't come often, and they don't announce themselves loudly. They appear quietly, usually when others are stressed, rushed, or forced to sell. If you're in debt, those moments pass you by. You're too busy managing payments, too busy worrying about cash flow, too busy reacting. So Buffett structured his life to always be ready for those moments. Not financially, but mentally. That's an important distinction. Most people think being ready means having money. Buffett knew it also meant having calm. Debt interferes with calm. When you owe money, even good news can feel stressful. You start asking whether it's enough, whether it will last, whether it will come in time. Without debt, good news is just good news. That emotional difference compounds over years. Another key part of Buffett's thinking was simplicity. He avoided complex setups that required constant attention. He didn't want systems that needed perfect execution. He wanted systems that could survive being imperfect. Debt adds complexity. It adds conditions. It adds timing requirements. Buffett avoided all three. This is why he favored businesses and investments that generated steady cash and didn't rely on constant refinancing or expansion just to stay alive. He didn't want to wake up each morning needing things to work. He wanted to wake up with options. Most people underestimate how valuable that is. Options don't always show up as money. They show up as the ability to say no, the ability to walk away, the ability to change direction without panic. Buffett built his entire approach around preserving those options. Debt erodes them slowly. Another important element of Buffett's development is how he separated growth from survival. Many people confuse the two. They believe that if something is growing, it must be healthy. Buffett knew that growth fueled by pressure is fragile. Debt-fueled growth looks impressive until it isn't. It requires constant motion, constant success, constant optimism. Buffett preferred slow growth that didn't require heroics. He didn't want to rely on perfect conditions. He wanted systems that could function under stress. This mindset shows up again and again in how he evaluated decisions. Instead of asking, "What's the upside?" he asked, "What could go wrong, and can I live with it?" Debt makes that second question uncomfortable, because the answer is often no. When you owe money, your tolerance for error shrinks. You can't afford delays, you can't afford mistakes, you can't afford learning curves. Buffett wanted wide tolerance for error. That's why he avoided situations where debt turns small problems into big ones. Another part of his development was how he viewed time. Most people treat time as something to beat, something to optimize, something to accelerate. Buffett treated time as an ally. But time only works for you if you're not forced. Debt forces timelines. It demands regular outcomes. It punishes pauses. It turns patience into a liability. Buffett refused to play that game. He was happy to let years pass without doing much, because he knew that the ability to wait is rare and valuable, and waiting requires independence. Buffett also understood that debt changes incentives in subtle ways. When you owe money, your incentives shift toward short-term results. Even if you tell yourself you're thinking long-term, your actions often betray you. You check results more often. You react faster to setbacks. You justify riskier choices. Not because you're careless, but because pressure changes priorities. Buffett designed his life to reduce pressure. That's why he often said he slept well. Not because he was fearless, but because he wasn't cornered. Sleep is a good test of financial structure. If your finances depend on things going right, sleep becomes fragile. Buffett didn't like fragile systems. Another key element is how Buffett viewed independence. He didn't like needing permission, financial or otherwise. He didn't like being boxed in by contracts, obligations, or deadlines he couldn't control. Debt creates silent contracts with the future. It assumes future income, it assumes future stability, it assumes future discipline. Buffett didn't like assumptions. He preferred certainty where possible and flexibility everywhere else. That's why he often chose the boring path. Boring paths don't get attention. They don't feel impressive. They don't make good stories, but they compound quietly. Debt-driven paths look exciting early. They create fast progress and visible momentum, but they rely on constant success. Buffett knew constant success isn't realistic. Another part of the development is how Buffett viewed self-control. He didn't assume he would always be rational. He assumed the opposite. He assumed stress would affect him. That emotion would cloud judgment. That fatigue would reduce clarity. So instead of trusting himself to behave perfectly under pressure, he structured his life to avoid pressure. That's wisdom most people miss. They believe discipline alone will save them. Buffett believed structure matters more than discipline. Debt requires discipline forever. Freedom forgives occasional mistakes. Buffett chose freedom. He also understood that debt narrows perspective. When obligations are heavy, people stop thinking creatively. They focus on survival. They stop asking big questions and start managing small fires. Buffett wanted the mental space to think clearly about big things. That space disappears when your attention is constantly pulled toward payments and schedules. Another important point. Buffett didn't avoid debt because he thought he'd never need it. He avoided it because he didn't want his future self to be trapped by his past decisions. That's a powerful idea. Debt is a promise your present self makes on behalf of your future self. Buffett was very careful with promises like that. He didn't assume his future self would have the same energy, health, or opportunities, so he avoided locking that future self into obligations. Most people do the opposite. They assume future success will cover present decisions. Buffett assumed future uncertainty and planned accordingly. This is why his approach feels conservative but works so well over time. He wasn't trying to maximize outcomes. He was trying to minimize regret. And regret often comes from being forced. Forced to sell. Forced to accept bad terms. Forced to act before ready. Buffett hated being forced, so he built a system where force had little power over him. No system is perfect. Buffett made mistakes. He missed opportunities. He waited too long sometimes. But because he wasn't leveraged, mistakes were survivable. And survivability is the foundation of long-term success. That's the core of his development. Not avoiding debt at all costs, but avoiding dependency, avoiding fragility, avoiding forced decisions. Debt makes you dependent on timing. Buffett wanted to depend on judgment, and judgment only works when your mind is clear. Now that we've explored how Buffett structured his thinking in life to avoid the traps of debt, the next step is the most important one. The moment where this thinking becomes unavoidable, the point where you realize why debt and clear thinking cannot coexist for long. That's where the climax begins. This is the point where the conversation stops being theoretical. Because by now, it should be uncomfortable. Not because debt is evil, not because everyone using it is wrong, but because you start seeing something you can't unsee. You start realizing that debt doesn't just sit quietly in the background of your life. It doesn't just wait patiently for payments. It actively shapes how you think, how you act, and what choices you believe are available to you. And once you notice that, everything changes. The real turning point is understanding this simple idea. Debt doesn't wait for things to go wrong before it starts costing you. It costs you even when things are going right. That's the part almost nobody talks about. When things are going well, debt feels harmless. Income is steady. Payments are manageable. Plans feel realistic. And because nothing is on fire, people assume nothing is wrong. But that's when debt is doing its quietest damage. Because even when life is smooth, debt introduces a subtle urgency into your thinking. It shortens your time horizon. It makes you less tolerant of waiting. It nudges you toward decisions that promise speed instead of stability. You don't feel trapped yet. You just feel busy, focused, motivated. But underneath that motivation is pressure. Buffett understood this deeply. He knew that the most dangerous financial states are not panic and fear. They're confidence and comfort. Because confidence makes people stop questioning. Comfort makes people assume the future will behave like the present. Debt feeds on both. When you're confident, debt feels like a smart tool. When you're comfortable, debt feels justified. And that's when people stop seeing risk clearly. The climax of Buffett's thinking is realizing that debt doesn't wait for a crisis to reduce your options. It reduces them the moment you sign up for it. You don't lose freedom all at once. You lose it gradually. First, you lose flexibility. Then you lose patience. Then you lose the ability to say no. And by the time you notice, your decisions are no longer based on what's best, but on what's required. Buffett always wanted to avoid required decisions. Because required decisions are rarely good decisions. They're rushed, they're emotional, they're defensive. They're about avoiding pain, not creating value. And debt manufactures those situations. The real shock comes when you realize that debt doesn't just limit bad choices. It limits good ones too. You might see a great opportunity, but can't take it because your cash is tied up in payments. You might want to walk away from a bad situation, but can't because income is locked into obligations. You might want to wait, but can't because waiting doesn't pay the bills. This is the moment where Buffett's thinking becomes painfully clear. Debt doesn't just push you toward risk, it pulls you away from opportunity. Because opportunity requires slack time, slack money, slack mental space. Debt removes slack, and without slack, everything becomes tight. Decisions, emotions, timing. That tightness is what Buffett avoided at all costs. Most people assume they'll handle pressure well when it comes. Buffett assumed the opposite. He assumed pressure would change him. So instead of trusting his future self to be perfectly disciplined, he designed his present self's choices to reduce pressure. That's the core insight. Buffett didn't rely on willpower. He relied on structure. Debt requires willpower forever. Freedom forgives human weakness. Buffett planned for weakness. He knew that fear, stress, and ego don't disappear just because you're smart. They show up when stakes are high, and debt raises the stakes of everything. When you owe money, every decision matters more. Every mistake costs more. Every delay feels heavier. And when stakes are high, thinking gets worse. People say they can handle debt because they've handled it so far. Buffett knew that past calm doesn't guarantee future calm. He wasn't afraid of losing money. He was afraid of losing clarity. Because once clarity is gone, money tends to follow. The real climax is this realization. Debt doesn't ruin people financially first. It ruins them mentally first. They stop thinking long-term. They stop being patient. They stop being selective. They become reactive. They chase returns they don't need. They accept deals they don't trust. They double down when they should step back. Not because they want to, but because they're cornered. Buffett always avoided being cornered. He knew that being cornered forces action, and forced action is rarely wise. That's why he didn't admire leverage. He didn't admire speed. He didn't admire complexity. He admired staying power. And staying power comes from freedom, not force. At this point, you might realize something uncomfortable about your own decisions. Not necessarily big mistakes, but patterns. Moments where you rushed, moments where you compromised, moments where you said yes when your gut said no. And if you're honest, debt probably played a role. Not directly, but indirectly. It shortened your timeline. It narrowed your choices. It raised the emotional cost of waiting. That's how debt works. It doesn't shout, it doesn't threaten, it nudges. Until one day, you realize you've been nudged far from where you intended to go. Buffett's brilliance wasn't in predicting markets. It was in predicting himself. He knew that under pressure, people behave differently, so he avoided pressure. He knew that under obligation, thinking degrades, so he avoided obligation. He knew that under deadlines, mistakes multiply, so he avoided deadlines he didn't control. Debt creates all three. And that's why his view on debt surprises people. Not because it's extreme, but because it's honest. It admits something most people don't want to admit. We are not perfectly rational, especially when we're stressed. Buffett didn't fight that reality. He worked around it. The climax of this video isn't about debt itself. It's about recognizing the hidden cost of being forced. Because once you see that, the math becomes secondary. Interest rates matter less than independence. Returns matter less than resilience. Growth matters less than survival. Buffett always played the survival game first. He believed that if you survive long enough with clarity intact, good things eventually happen. Debt threatens that survival, not immediately, but steadily. It makes your future dependent on your past assumptions. And life is very good at breaking assumptions. That's the moment where everything clicks. Debt isn't dangerous because it's immoral or irresponsible. It's dangerous because it assumes stability in a world that doesn't promise it. Buffett never made that assumption. He planned for change. He planned for mistakes. He planned for uncertainty. And debt didn't fit into that plan. Once you understand this, debt stops looking like a neutral tool and starts looking like a trade-off. A trade-off between speed and freedom. Between growth and resilience. Between comfort now and control later. And Buffett always chose control. That's the heart of his thinking. And that's why this idea matters so much. Because when you stop being forced, you start seeing clearly again. And when you see clearly, you stop making decisions just to survive. You start making decisions to build something that lasts. After walking through all of this, one thing should feel very clear by now. Warren Buffett didn't think about debt the way most people do because he wasn't trying to win fast. He was trying to stay free. Free to think. Free to wait. Free to say no. And that freedom mattered more to him than any short-term gain. Most people measure financial success by how quickly they can grow, how much they can borrow, or how efficiently they can put money to work. Buffett measured it differently. He measured success by how little pressure he had on his decisions. Because pressure changes everything. Pressure shortens time horizons. Pressure lowers standards. Pressure makes people confuse movement with progress. Buffett didn't want his decisions shaped by pressure. He wanted them shaped by judgment. That's why debt never felt neutral to him. Even when the numbers looked fine. Even when the math worked. Even when others said it was smart. He saw what debt really does over time. How it quietly limits options. How it turns flexibility into obligation. how it pushes people to act before they're ready, and most importantly, how it interferes with clear thinking. Buffett understood that you don't need to be brilliant to succeed financially, but you do need to be able to think calmly when others can't. And calm thinking is almost impossible when you're forced. Debt creates force. It forces timelines. It forces outcomes. It forces behavior. And when behavior is forced, quality disappears. That's the deeper lesson here. Not that debt is always wrong, not that everyone should live without it, but that every dollar owed comes with a cost that isn't listed on the statement. A cost to patience, a cost to optionality, a cost to clarity. Buffett wasn't afraid of missing opportunities. He was afraid of being trapped by them. He knew that the biggest financial mistakes don't come from doing nothing. They come from doing something because you feel you have no choice. He built his life to avoid that feeling. That's why he could wait while others rushed. That's why he could say no while others chased. That's why he could stay calm while others panicked. Not because he was smarter, but because he wasn't cornered. Most people don't notice how cornered they are until something goes wrong. Until income slows, until markets fall, until life throws something unexpected into the mix. Buffett noticed it before that. He noticed how debt narrows thinking even when things are going well. How it creates silent deadlines, how it turns the future into a series of payments instead of possibilities. So he chose a different path, a slower path, a quieter path, a less impressive path on the surface, but one that gave him control. And control is the real advantage. When you have control, you don't need predictions. When you have control, you don't need perfect timing. When you have control, mistakes are manageable instead of fatal. That's what Buffett optimized for. Not maximum upside, but minimum regret. Not constant growth, but long-term survival. Not leverage, but resilience. This way of thinking doesn't just apply to investing. It applies to business, to careers, to life decisions. Any situation where debt or obligation forces you to act before you're ready carries the same risk. The risk of making decisions for the wrong reason. Buffett avoided that risk relentlessly. He didn't do it because he hated debt. He did it because he respected uncertainty. He knew the future wouldn't behave nicely. He knew markets would surprise people. He knew life would interrupt plans, and he wanted to be ready for that. Not financially, but mentally. That's the part most people miss. We spend so much time talking about returns that we forget the real goal is to stay rational long enough for good outcomes to happen. Debt works against that goal. It speeds things up when slowing down would help. It demands action when waiting would be smarter. It creates urgency where patience would pay off. Buffett chose patience. He chose to protect his thinking above everything else. And that's why his view on debt feels surprising. Not because it's extreme, but because it's honest about human behavior. It admits that we don't always think clearly under pressure. It admits that we make worse decisions when forced. It admits that freedom matters more than efficiency. Buffett didn't try to outsmart these truths. He worked with them. So when you look at your own decisions, the question isn't whether debt is good or bad. The question is simpler and more important. Does this give me more freedom to think clearly or less? If it gives you less, the cost may be higher than it looks. Because once clarity is gone, everything becomes harder. Waiting becomes painful. Mistakes become dangerous. Opportunities become invisible. Buffett understood that wealth isn't just about what you own. It's about what you don't owe. Not owing gave him space. Space gave him patience. Patience gave him opportunity. And opportunity, given enough time, did the rest. That's the lesson. Not to copy Buffett's life. Not to avoid every form of debt, but to respect how deeply obligations shape behavior and to protect your ability to think clearly for as long as possible. Because in the end, the people who last aren't the ones who move fastest. They're the ones who stay free. Watch the next video.